Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for Election Day 2021, November 2nd. I'm Ken Adamo, Chief of Analytics at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Good morning, guys.
Morning.
Good morning.
As you can tell, I'm obviously dealing with some head coldness here, so you guys are going to have to pick up the slack a little bit today. A little bit of a reprieve for the audience not to hear my voice all morning.
Right. We got you.
So for those not familiar with the show, we're here every week talking about what we're seeing in the freight markets, looking at trends, answering your questions submitted throughout the week, but most importantly, answering your questions live. So if you have any questions, thoughts, concerns, comments, please drop them in the comment or chat below. We have folks that will get those over to us at the end of the show. I think we had a record number last week and didn't even get to all of them. So if you can, please get them to us early in the show. We'll queue them up and answer them towards the end. We have a lot to cover this week as we change into November, so I'm going to jump right into our key trends for the week. So spot rates relatively flat. Again, so they're bumping up against this ceiling, if you will, this sort of false ceiling that we've been talking about. The Dean will go into more detail later in the market update. Contract rates down a little bit. I think there's some routing guide shifting going on, which speaks to these next 2 points within contract rates, which I think are monkeying with that a bit. Obviously, it's November. We're not talking about Halloween candy anymore. We're talking about turkey. So Dean's going to cover that as produce and turkey start shipping. Make sure they hit the grocery store shelves. A lot more expensive this year if you haven't priced your bird yet. And daylight savings is this week. There's obviously a safety concern among truck drivers, but anyone with young children knows that daylight savings is the bane of our existence. And we will all be up at 4 or 5 o'clock on Sunday morning. So with that, I'll turn it over to Dean to walk us through the market update.
Yeah, thanks, Ken. Lots to cover this week, so let's dive right in. Dry van load post volumes ended last week about 10% lower than the end of last month, which is kind of unusual for this time of the year, given end-of-month freight push generally pumps up volumes a little bit, but lower month over month, down by 10% compared to the end of September. Still about 34% higher than the same week last year, so still plenty of activity in the spot market. Equipment post decreased slightly, so the loaded truck ratio moved up slightly from 5.14 to 6.01 last week. In the refrigerated category, load post tracked very closely with dry van last week, still down about 10% month over month also, and up about 41% compared to this time last year. Load to truck ratio moved up from 10.76 to 12.61. And in the flatbed sector, load post volumes were up about 12% last week, down about 9% month over month. So all three categories are in that 9 to 10% down month over month. In the flatbed sector, equipment posts were unchanged last week, so the load to truck ratio moved up to 47.77. Having a look at the market condition index for dry van, of course, the West Coast port congestion remains very topical. We've got 73 container vessels at anchor this morning. That includes 31 physically anchored near to shore, but another 42 loitering about 40 miles offshore. The Port of Los Angeles has average wait time at 13.4 days, which brings us to our number of the day, which is 51. That's the number of days that the Akinka from Yanshan, China, has been waiting at anchor, 51 days at anchor to get alongside. That's on top of the 21 days average sailing time from Asia. So it makes about 71 days since that vessel departed for the US. And we've only got 53 days left to Christmas and 23 days left at Black Friday. So we've got about 538,000 containers sitting on vessels this morning. So with 53 days, sort of left before the big end of season event, there's a lot of containers that just aren't going to make it to where they need to be based on where we're sitting right now. In Los Angeles, capacity was tight again. Spot rates inched up only at 1 cent per mile last week to an average outbound rate of 3.37. One of the big lanes, Los Angeles to Stockton, set another record weekly high last week of $4.30, excluding fuel. Southbound from Portland to Stockton, rates are up 2 cents to an average of $1.54. Capacity was tight Philly to Buffalo, up to 2 cents a mile to $4.04. For context, that's 80 cents a mile higher year over year. So that's Philadelphia to Buffalo at 4.04. In the refrigerated category, truckload capacity is still very tight in Seattle and Oregon. Markets, 23% increase in load post volumes last week. Reefer spot rates jumped 18 cents a mile to an average of 262. Seattle to Los Angeles last week, 63 cents a mile higher than this time last year at 224. Los Angeles to Las Vegas, one of the busier reefer lanes, still at 605, $6.05 per mile. That's 95 cents a mile higher compared to this time last year. On the East Coast, capacity was tight deep in Florida last week. Average outbound rates were up 6 cents to $1.50. And there was a 40% week-over-week increase in load post volumes in the Lakeland market, which includes Orlando. Down on the McAllen market and the southern border, lots of produce coming across. There was a 30% jump in reefer load post last week. Spot rates were up 15 cents a mile to an average of $2.55. And of course, we'll talk a little bit about fresh turkeys a bit later. Lots of activity in South St. Cloud and Fargo, North Dakota. We'll cover that in our DAT IQ question of the week. Wrapping up our market condition index with a look at flatbed, along with reefer capacity that was tight in Miami. Flatbed capacity was also tight last week. Outbound rates averaged $2.55 a mile. That's up 29 cents a mile in the last week. Spot rates up in Gary, Indiana, increased by 24 cents a mile to an average of $3.45. Capacity was particularly tight on the run to Louisville, Kentucky. Rates are up to $3.66. Loads from Gary, Indiana to Boston, east to Boston, and even Springfield, where there's a lot of manufacturing. Rates were up 5 cents a mile last week to an average of $3.87. That's $1.02 a mile higher than this time last year. And wrapping up with our year-over-year view of spot rates, after declining in the 2 weeks prior, last week's national average dry van rate remained largely unchanged. Quite unusual for the end of month, though. Could be another sign that the capacity is easing. We'll have to wait for that trend to cement itself a little bit more. Spot rates ended the week where they started pretty much at $2.49, still up 35 cents a mile higher than this time last year. In the refrigerated category, spot rates ended the week largely unchanged also, despite fall produce and Thanksgiving shipping volumes ramping up. Rates are still around $2.84, which is still 46 cents a mile higher than this time last year. And lastly, in the flatbed capacity, eased a little bit last week. They've been decreasing slightly for about 4 weeks in a row, down about 7 cents a mile month over month, averaging $2.59 excluding fuel at the end of last week. And comparing to the same week last year, rates are still 34 cents a mile higher and 44 cents a mile higher than where they were in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report for the long form version of today's report. Over to you, Ned, for the short-term forecast.
All right, we're going to be starting off with the van short-term forecast. Here in blue, you can see the market rates observed by DAT. And then off to the right, you can see our model suite. In green is the RateCast model, which is our flagship model, which is expecting rates to maintain about their current levels for the next 2 weeks, with an increase happening in the later part of November, early part of December. Meanwhile, in red, our short-term model is expecting a sustained slide in rates of about 7 cents, moving through that same 35-day period. And then in gold and silver, we have our two blended forecasts, which are mixtures of the two forecasts in different amounts and in different ways. Here, they're leaning a little bit more towards the RateCast model, heading up a couple of cents, although there's a little bit of a dip in the next couple of weeks by, I'd say, about 2 or 3 cents per mile. And these are all national figures in case that wasn't made clear. Next up in reefer, here we have actually a lot of model divergence. Once more in the blue, we have market rates observed by DAT. And then off to the right, we have our short-term model in red, maintaining levels at about the same with a slow slide of about a penny over the next 35 days. In contrast, our RateCast model is expecting a really sharp shock upwards as we move into the Thanksgiving season. The reason for this particular model divergence is that the short-term model has some knowledge of holidays, but doesn't have this sort of long-term market perspective about the lead up and the ramp down. It handles things like 4th of July a lot better than it does something like Christmas, where there's a lot of freight that needs to be moved, or a great deal more freight in a relatively compressed time period, which is one of the things that RateCast is pretty good at. So assuming that there are normal seasonal patterns, we'll see this very sharp shock upwards of about 10 to 12 cents a mile heading into the Thanksgiving holiday. Meanwhile, in gold and silver, the two blended forecasts are leaning a little bit more towards RateCast, but have their expectations tempered slightly. They're up 5 cents over that same period, with a similar shape of a short, sharp shock upwards and then a slide down after we move through Thanksgiving. Finally, in flatbed, we begin with, in blue, the market rates observed by DAT. And then off to the right, you can see our short-term model expecting a continued slide downwards of about 12 cents over the next 35 days. In green, RateCast is expecting a similar correction early, but then it breaks, expecting at about the 2-week mark things to flatten out with a total drop of about 4 cents over those 35 days, with a flat period once we get into the middle part of November. The blended forecasts in gold and silver are expecting more of what the short term is seeing, where they are dropping by about 7 to 8 cents over that 35-day period, but are overall maintaining the downward trend that we've been seeing in flatbed. And that will bring us, speaking as we had of Thanksgiving, that brings us to our IQ question of the week. What impact do we expect Thanksgiving to have on reefer freight?
Okay.
Yeah.
Would you like me to set this up?
Please.
I think we have our resident turkey shipping expert, Dean Croak,
Talking turkey.
on board, talking turkey.
Yeah, so I looked into some of the markets yesterday and had a look at where all the turkeys come from. Most of the counties are up in the in what we'd call our St. Cloud, Minnesota, and Fargo, North Dakota markets. Their location's very key when it comes to turkey farming. A lot of them are located near their food source, because 2/3 of the cost of raising turkeys are in fact feed. So that's why you see a concentration of them in the Midwest. Top 5 producing states: Minnesota, North Carolina, Arkansas, Missouri, and Indiana. They're the big states. The big difference this year, though, turkeys start moving 2 to 3 weeks out from Thanksgiving. We're in that zone right now where volumes and rates are starting to rise. But one of the big differences this year, like every other supply chain, shortages of things that are Thanksgiving related. One of the reports out this week showed that out-of-stock rates are about double where they were this time last year for things like whipped toppings, liquid gravy, pies, pastry shells, refrigerated pies, and bakery pies. The big thing that the retailers are pushing people towards are substitutions for those things, which could have an impact on some some freight lanes and density on those lanes as different types of products start moving. Minnesota's the big one, so we'll focus a little bit of our activity today around Minnesota. It's the number 1 state. They'll produce about 42 million birds each year. In the St. Cloud, Minneapolis, and Fargo, North Dakota markets, reefer rates are up 18 cents a mile this week, averaging $3.45 a mile. Peak volumes are likely to be next week, according to some growers. In the largest turkey producing market, where most of the counties are concentrated, is St. Cloud. Reefer rates are up 23 cents a mile to $3.44. Some long-haul lanes are up around $4 a mile already. Capacity is tight on runs to Dallas at $3.94, $4 a mile to DC, $4.07 to Louisville, Kentucky. So right now, when I put the 5 turkey-producing states sort of in one bucket, that's about 2/3 of the annual production. Spot rates are averaging $3.42, which is about 20% above the national average as we sit today, about 3 weeks out from when Thanksgiving starts. So that's the preamble, guys. What are your thoughts?
I think if there's anything like a normal cycle, reefer rates are going to go up. Like, yes, out of the turkey producing markets, but just all over. There's a lot of refrigerated goods that are going to be moving. That said, things are weird. The supply chains are kind of goofy this year, and so that shock might be structurally different. The shape of it might be different, where it might be more concentrated into the back half if things aren't moving, or it might be kind of pulled forward if people are willing to pay a premium to try and get the capacity that they can to get those sort of time-limited items through. Ken, do you have a perspective?
Not on the refrigerated side, honestly. I just hope it all shows up. Make sure we have all of our side dishes. I mean, I'm more closely watching the retail side of things, the hard goods, if you will, Black Friday shipping. It seems like a lot of the stuff that's going to get there for Christmas, or for Black Friday, I should say, it needed to clear through the first mile anyway by about now, right? These next few weeks should be middle miling it, and then culminating and final miling it to brick and mortar or forward stocking locations for e-commerce. So It's go time, right? I remember that when I was in the industry, that calendar turned from October to November. You started to really ramp up how much you focused on the hard lines side of the retail piece.
And even, the other part is we've got some pretty heavy snow out in the, the northern latitudes already. Out in Wyoming, there's some really heavy snow across. I think it was 80 and 90 yesterday. So, it's tough sledding for a lot of the carriers in those colder states already, particularly in the upper northwest area. So that's going to impact capacity. But in looking at our long-term ratecast forecast, Ned, in RateView this morning, it looks like there's about, from where rates are sitting now, somewhere in that 10 to 15 cents a mile movement on some of those lanes still to go before we hit it, before we hit our Thanksgiving peak. So that's, the one in particular caught my attention was out of St. Cloud. I think it was to DC, which is one of the big markets for turkey consumption. It was at 380 this week. Its ratecast is forecasting at 402 per mile as a peak at Thanksgiving.
Yeah.
That's excluding fuel.
Yeah.
So there's some room to go.
Yes. No. So now is the time for profit taking if you're in the reefer sector as a carrier. If you're a broker, I'm sure you've been experiencing kind of the capacity crunch overall, but hopefully you'll be able to make your loads and cover everything. We ready for some listener questions?
Yeah, go ahead and get those listener questions in if you have anything. We're running a bit early today, so we should have some time. We already have a few piled up, but if you have any that you want to get answered, let us know.
All right, from Lazar Jovanovic. Hello, how does DAT Power eliminate data, noise, and heat maps in cases where a carrier or broker posts the same truck or load multiple times in different locations to ensure accuracy? Power doesn't do that, but MCI does. So our market conditions index, one of the big advances, or one of the big differences between it and the load to truck ratio is that MCI does this kind of overposting detection, and it turns down the noise on what's happening. So an overposter isn't necessarily shut off. Sorry, I'm going to use the term overposting to refer to people doing things like posting the same load at slightly different origins and destinations to kind of make sure that their load gets covered. Or another piece of activity that they do is deleting a post and then refreshing it, reposting it to try and move it up to the top of the rankings. Please don't do that. Please use the post refresh feature, and that does the same thing without making our statistics wonky and requiring us to pull it out, but some people do that anyway. So we have inside of MCI overposting detection, which turns down the noise on it a little bit. Again, we can't completely eliminate that because it is a real signal in terms of desperation. Like if we see that overposting goes up, but it just makes the kind of heat signal nonlinear, where instead of, if you've got twice as much demand, posts go up by a factor of 2, instead posts go up by like a factor of 10 or so when you get to the very high demand situations because of the overposting. And that is a real signal. So we do our best to kind of turn that down, but still capture what's going on underneath. Was that too technical? Did I cover that?
No, I think the way you summarized it in the past, and the way Jen McLam, who developed MCI, summarized it in the past, is it turns down the volume. It doesn't eliminate it. We don't select delete. We just turn down the volume on some of that overposting. It helps normalize markets as well. So I think that's pretty good.
Yeah, and that's only an MCI. Load to truck ratio and power don't, and the power load board by default don't do that.
Oh, correct. Yeah.
Yes. Isaac Dibb, what's a good lane for cross-country reefer for the next few months? Do you think apples and pears in the Northwest will hold as long as usual with the warmer than normal temperature? And he also asked, what are the best turkey lanes?
I mean, some of the Pacific Northwest is just generally capacity is very tight right now. One of the better lanes, I think, is going to be from that Oregon market in particular, Yakima Valley. Let's call it Yakima Valley down through there to Twin Falls to either Chicago or south to Los Angeles is going to be very strong. Rates are going to be pretty good to attract carriers out of the Seattle Portland market because there's more empty miles involved, and there's more volume in the Seattle market right now because of higher imports. So capacity is going to tighten, particularly on those southbound lanes out of the Pendleton market in particular to Los Angeles. What's the second part of the question, Ned?
Turkey lanes. I feel like you covered that a little bit.
Yeah, I think anything out of St. Cloud, Minneapolis, St. Cloud, Fargo is going to be pretty hot in the next week or so.
All right, Victor Napier. Hello, is there a way to save companies one would like to call so one could create a list? Thanks. If you are using our mobile app, DAT Trucker, I think it's called, there is a feature called Work List, and you can save individual posts or brokers or carriers, for that matter, if you use that as a broker, although I can't imagine that you would, but if you do, you can save those to Work List. We're trying to add that feature to our other products, so that you can have this work list of kind of a digital Rolodex to help you keep track of the other your counterparties that you've done business with before. If you're a broker, a tool that can be helpful if you've onboarded somebody in the past, Carrier Watch, that'll also give you an alert if their insurance information or their service information changes, so that you can be notified if somebody is slipping out of insurance coverage, or otherwise there's an accident safety change rating, etc. So you can make sure that you're doing the best kind of business that you can with your partners. But that's it's primarily intended on a broker to carrier basis. And it works best for people that you've already onboarded.
And you can reach out to customer support to help you with those features as well.
Yes, absolutely. David Miller, do you see any drop off after Christmas?
Second week of January, we'll see seasonal decline, right? It's extended the holiday period a little bit longer due to e-commerce returns. So I would expect, just like they did this year, things to contract. Hopefully we don't have another polar vortex, but I would expect things to ease after roughly that second full week of January.
Yeah. Again, I think that this next year is going to be a really interesting one. You know, we were really expecting 2021 to get more back to normal, and instead we're at $380 a mile on a bunch of lanes. But we'll see.
No bueno.
No bueno.
Sorry,
go ahead.
I was just thinking, one of the things to watch is that right now there's a lot of urgency to move freight, particularly out of the congested ports. So whether you think about Oakland, Seattle, Savannah, Los Angeles, a lot of urgency is tied to some of the escalating spot rates we're seeing on some of those lanes. So I just wonder whether after Christmas, when that freight that doesn't make it to market, that's still tied up on in ports with congestion, whether that just slows right down and the urgency goes out of the spot market on those lanes. It's a distinct possibility.
We'll see.
Yeah. Rick Vogely, I believe, asks how you can get to MCI. I will tell you the way that I navigate to MCI, and that's if you are in Rate View, where I spend a lot of my time, and you click on the little map inside of Rate View. There's like a map of the markets in the upper part of the screen that will take you to MCI. I believe you can also get to it directly through the Power interface. I don't sit in Power as much, and so I don't have like an easy way to get there. If you're interested in the data side of it, our folks at Enterprise Data Services at DAT are absolutely 100% willing and able to give you that information in some kind of a format that you can use, whether it's Snowflake, CSV, whatever. Sorry.
We have an API as well, but if you want to just go straight there and cut to the chase, it's market maps, all one word, .dat.com. And if you have a subscription to MCI, it will single sign-on for you, and you can log right in.
Thank you.
One more question.
Yes, Scott Constable, good morning. Do you guys discuss grain fertilizer hauling hopper? Thanks.
No.
Not in detail, no.
If you would like us to and have a more specific thing you'd like, we have a conference room in Beaverton named Hopper Bottom, which is a truck type. But no, we don't really get into that. Kind of for the same reason we don't talk about food grade bulk liquid versus non-food grade bulk liquid. Right? So it's a very thin data set. But if you have a question, look, we're always looking to get deep into something, and we'd be happy to discuss. So just drop us a line in the comment section or ask IQ@dat.com, and we'll take a better look at it for you and see if we have anything interesting. That's all the questions I see. Anything else? Ned, I don't see anything else. No. Any plugs? Dean, where are you going to be at this week?
Yep. On Landline Now at 7 p.m. Eastern tomorrow night on 146 Sirius XM Road Dog.
Anything interesting going on in your world, Ned?
not that I could talk about on. I'm working on some new products that are
You don't want
ready
to
to be
enlighten our
debuted yet.
listeners on refactoring data science code for production? Really?
Oh God, it's fine. It's fine. It's just like I never wanted to get into the guts of Kubernetes, and here I am, right in the guts of Kubernetes. It's fun. Love and
Fun.
life.
Fun. Well, hey, thanks everyone for joining. It was a bit of a quick show this week. We got through it very effectively. I don't hate it, given my upper respiratory condition, and Dean's been scrabbling things together with the internet outage in the Northeast due to the weather last week. So we really appreciate you tuning in.
Right.
We'll be here next week. And if you have any questions throughout the week, feel free to drop us a line at askiq@dat.com. And short of that, get out there and vote. And we hope you have a safe and productive week. And we'll see you back here same time next week. Bye, everyone.
Okay. Bye-bye.
Bye.